Welcome to the Deep Dive, your shortcut to being, well, truly well-informed. Today, we're putting on our Talk Tickers hats. We're going to meticulously break down the latest earnings call from GrafTech International Ltd.
EAF, that's the ticker.
Exactly, EAF. Now, this isn't just another company. It's, a really pivotal player in metals and mining.
Right. They do graphite electrodes, petroleum, needle coke.
Essential stuff for steelmaking and actually increasingly critical for some of these emerging energy technologies, too.
That's becoming a big part of the story, yeah.
So, our mission today, distill the most important nuggets of insight from their Q2 2025 results and outlook. Give you a clear picture of where they stand and maybe where they're headed.
And it was a really fascinating quarter for GrafTech. Sort of a dichotomy, actually.
How so?
Well, on one hand, you had some headline financials that might have given you pause, missed on some earnings metrics. But then the market reaction was surprisingly enthusiastic, really seemed to like the operational execution and the strategic roadmap management laid out.
Interesting. So the market saw something beyond the numbers.
Exactly. We're going to really dig into how they're navigating this pretty complex environment. They seem focused, laser focused really, on the things they can control.
Building a stronger foundation for the long term, maybe?
That seems to be the plan, yeah.
All right, let's kick things off with those headline numbers. Q2 2025. GrafTech reported revenue of $131.8 million.
Right, and that actually beat analyst expectations. So a nice beat there on the top line.
But there's usually a but.
Well, yeah. The non-GAAP adjusted earnings per share, that came in at negative $0.16.
Negative 16 cents. That missed consensus estimates, didn't it?
It did by about 4 cents. And the GAAP EPS, the official number, was even lower, negative $0.34.
Oof. Okay, so definitely a mixed bag on the financials. Revenue beat, but earnings miss.
And that's precisely where the story gets interesting, because despite those earnings misses, the market, well, it clearly looked past the immediate bottom line.
What did it focus on then?
The operational wins. That's what really caught investors' eyes, I think. Led to a pretty big positive move in the stock that day.
Okay, like what specifics?
For starters, sales volume. It increased by a notable 12% year over year.
12%? That sounds pretty good.
It is. Hit 28.6 thousand metric tons. That's their highest volume in nearly 3 years.
Wow, yeah.
And it wasn't just volume. Capacity utilization also climbed up to 65%, another 3-year high.
So they're selling more and making better use of their factories.
Basically, yes. Tells us they're getting more efficient, using their assets better, which is, crucial right now.
So we're seeing strong operational momentum despite those profitability challenges. Maybe we should clarify just quickly that difference between non-GAAP adjusted EPS and GAAP EPS. Why does the market sometimes focus on one over the other, like here?
Yeah, that's a really crucial question. So GAAP, generally accepted accounting principles, that's the standardized view, right? The official one. But it includes things like non-cash charges, depreciation, amortization, maybe some one-off items that don't really reflect the day-to-day operational health.
Okay.
Non-GAAP or adjusted earnings usually strips those out. The idea is to give a clearer picture of the core operating profitability.
Makes sense.
And in GrafTech's case, with the industry facing headwinds, investors seem to be giving more weight to that adjusted number as sort of a proxy for the underlying business performance.
Especially if management's trying to fix the things they can control.
Exactly. Focusing on the controllables.
And speaking of controllables, you mentioned operational wins. They also reported something about costs, right? Cost of goods sold.
Absolutely. This was another major win, I'd say. They achieved a substantial 13% year-over-year reduction in cash cost of goods sold per metric ton.
Cash COGS. Why is the cash part important?
Well, it refers to the direct out-of-pocket expenses to actually produce each ton. It excludes those non-cash items like depreciation, so it really impacts their operational cash flow.
Got it. So it shows real, tangible cost cutting.
Precisely. And tied to that, they also reported positive adjusted EBITDA. Only $3 million, but...
Positive is positive.
It is. It marks their first positive EBITDA since Q2 of last year. So for many, that signals maybe a turning point in their profitability.
Okay, so the immediate takeaway seems pretty clear then. Despite some earnings figures not hitting the mark, the market really rewarded this strong operational performance.
And the clear strategic path forward, yeah.
It's almost like investors were saying, okay, we see the foundational improvements, even if the headline profit isn't quite there yet.
I think that's a fair assessment of the reaction.
Okay, let's unpack this further then. Let's really explore the strategic initiatives that powered these pretty impressive operational results. What exactly is GrafTech looking at for the rest of 2025 and, beyond?
Well, management laid out a very clear, sort of multifaceted plan. The focus is pretty straightforward. Increase sales volume and regain market share.
Okay.
Improve average pricing, both through direct price increases and also shifting their geographic mix strategically.
Right, selling more in better places.
Exactly. And then relentlessly reducing costs and working capital requirements, and ultimately just strengthening their overall financial foundation.
Sounds comprehensive.
And we're seeing, tangible progress here. It's not just talk.
Let's start with that commercial strategy.
Yeah.
Driving sales volume, improving pricing. How are they doing that in what's still a pretty competitive market?
Well, a core piece of it has been driving a U.S. mix shift.
Focusing on the United States.
Yeah. They reported an impressive 38% year-over-year volume growth right here in the U.S. And critically, that's their most profitable region.
Okay, so higher margin sales.
Precisely. And just that strategic geographic shift alone contributed about $80 per metric ton to their weighted average selling price in Q2.
$80 a ton just from selling more in the U.S.
Yeah. That's a significant figure, right? Helped partially offset the overall year-over-year average selling price decline they've been battling.
That makes sense.
And they also made a pretty decisive move, implementing a 15% price increase on uncommitted 2025 volume.
For next year's sales they haven't locked in yet.
Correct. It shows, I think, a clear commitment to prioritizing value-focused growth. They're not just chasing volume at any price. Might even walk away from lower margin deals.
That sends a signal, doesn't it?
Yeah.
Not desperate for volume. Okay, so it's not just selling more, it's selling more profitably to the right customers. That's one side. What about internal efficiencies? How are they tackling costs? That's just as vital for margins.
Absolutely. On the cost and operational efficiencies front, that 13% year-over-year decline in cash CAR-GS per metric ton we mentioned?
Yeah, the 13%.
That was a monumental achievement, really. It speaks to a deep, kind of granular focus on optimizing their operations.
And they seem confident they can keep it up.
They do. In fact, they even raised their full-year guidance for cash COGS reduction, now looking for a range of 7% to 9% year-over-year.
Raised guidance on cost cuts. That's usually a good sign.
It is. They're targeting around $3,950 per metric ton for the full year. And this reduction is being driven by a few things. Innovations in R&D,
Okay.
leveraging technology investments they've made, optimizing procurement, getting better deals on raw materials, and lowering fixed costs. Plus, higher production volumes help spread those fixed costs out.
Right, it becomes sort of a virtuous cycle.
Exactly.
It's a huge commitment to efficiency. Very impressive to see them raise guidance like that in this environment.
Yeah.
What about their broader financial health, though? How strong is the balance sheet to support all these shifts?
Yeah, good question. From a financial foundation perspective, well, adjusted free cash flow was negative $53 million in the quarter.
Negative 53, that sounds like a lot.
It does, but it was largely due to a big $39 million cash interest payment. That's more of a timing thing, not necessarily a structural issue every quarter.
Okay, so maybe not as alarming as it sounds at first glance.
Perhaps not. And their overall liquidity remains quite robust, $367 million.
That's their available cash and credit.
Correct. And critically, they have no substantial debt maturities until December 2029.
Not until 2029. That's a long way off.
It is. Provides them with considerable financial flexibility, a long runway to navigate any current industry headwinds, absorb challenges, and importantly, keep making those strategic investments without immediate pressure from creditors.
And for the full year outlook.
They anticipate being at or slightly above break-even for adjusted EBITDA, which, would be a notable and vital improvement from the previous year.
That strong liquidity and the long debt runway until 2029, that really sounds like a significant advantage, especially in a tough market. How does that financial stability specifically empower their strategy? Does it let them be more aggressive, maybe, in regaining share or investing in that battery opportunity?
Oh, absolutely. It's a huge competitive edge. That financial stability gives management optionality. They can be patient. They can be strategic.
They don't have to panic.
Right. They don't have to chase unprofitable volume just to service near-term debt. Instead, they can prioritize that profitable U.S. mix shift we talked about. They can invest in R&D for next-gen products, and they can actively pursue that battery materials opportunity, even if it takes time and investment to really scale. Compared to competitors who might be more leveraged or facing tighter cash flows, GrafTech can afford to play the long game.
Which is essential in these kinds of capital-intensive industries undergoing big changes, isn't it?
Absolutely essential.
Okay, we've broken down the quarter, their immediate strategic moves. Now, I'm genuinely curious. Beyond these immediate results, what are the overarching macro shifts? What's the bigger picture GrafTech is really betting on to fundamentally transform their outlook over the next few years? What could truly move the needle here?
Okay, yeah, this is where it gets really interesting. Looking at the broader industry context and those long-term tailwinds, GrafTech seems to be positioning itself to capitalize on two major structural shifts. Huge shifts, really, reshaping the industrial landscape.
Okay, what's the first one?
The first is the ongoing, decarbonization-driven shift towards electric arc furnace steelmaking, EAF.
Greener steel.
Greener steel, exactly. This isn't just a minor trend. It feels more like a global mandate now. EAF accounted for, 51% of steel production outside of China in 2024, and it's projected to keep climbing.
So more EAF means more demand for their core product, those graphite electrodes.
Yeah.
How does that translate to the market, particularly here in the U.S.?
Well, the U.S. market is already pretty robust, around 77% capacity utilization for EAFs. But crucially, there's over 20 million tons of new EAF capacity that's either recently come online or is planned for the coming year.
20 million tons. That's a lot of new demand potential.
It is, and more announcements are expected. This trend just unequivocally bodes well for graphite electrode demand long term. Every new EAF mill is basically a new customer, a direct demand driver.
So that's not a maybe scenario. That's happening.
Driven by global decarbonization efforts. Yeah, seems like a certainty. Now, the second major opportunity lies in battery materials, and this is potentially really exciting for them.
Okay.
GrafTech's unique vertical integration. They make their own petroleum needle coke, which is a critical raw material for synthetic graphite that positions them perfectly for emerging opportunities in EV battery materials and, broader energy storage, too.
That sounds like a potential pivot almost, or at least a major expansion into a high-growth sector. And I remember reading something about government action recently, tariffs.
Precisely. This is especially relevant given recent U.S. government actions, basically reshaping global supply chains for critical materials.
What happened exactly?
The U.S. Department of Commerce just imposed preliminary anti-dumping tariffs of, get this, 93.5% on Chinese graphite anode material imports.
93%. Wow.
And that stacks with previous tariffs. So the combined duty is now around 160%.
160% tariff on Chinese graphite anodes.
Yeah. This isn't just a minor trade skirmish. It signals a really strong government intent to foster an ex-China supply chain for critical minerals right here at home.
And GrafTech sees itself playing a role there.
They absolutely do, with their deep expertise in needle coke, synthetic graphite production. They see themselves as a valuable strategic partner, is the phrase they used, perfectly positioned to benefit from this onshore manufacturing push. They've got the vertical integration, the technical know-how.
In a sector that desperately needs domestic options now.
Exactly.
And it's worth noting, too, they also mentioned some potential recovery in Europe, saw some volume growth there, even though the overall market was down.
Yeah, that's a crucial point. Their Western Europe sales volume was up about 27% year to date, despite overall regional steel production actually declining.
So that suggests they're not just riding macro trends, they're actively taking share, even in tough markets.
That's what it looks like. It showcases their commercial agility. Even if regional demand is down, gaining share means they're effectively competing and winning business from rivals.
Which positioned them really well if and when Europe does recover.
Exactly. Proves their strategy isn't solely dependent on a rising tide lifting all boats. It's also about their own operational strength.
Okay, so putting it all together.
Yeah.
What does this mean for you, the listener, as an investor? We saw that immediate positive market reaction. Stock rallied over 14% on the day.
Big jump.
But analyst sentiment you mentioned was a bit more cautious. Some calling it a high-risk bet, saying the green shoots weren't fully visible in the results yet. How do we reconcile that difference?
Yeah, the divergence really highlights a key point. Investors, or at least the market that day, prioritize the tangible operational execution and that clear strategic pathway over the headline EPS miss.
They looked at the controllables again.
Right. The market rewarded the robust volume growth, those significant cost reductions, the raised cost down guidance, seeing these as crucial controllables in what's still a challenging pricing environment.
Those are the green shoots, maybe. The underlying improvements.
That's how the market seemed to read it, yeah. These suggest future profitability. Plus, you had recent corporate actions like regaining NYSE price compliance.
They did that reverse stock split, right?
Approved a 1-for-10 reverse split. Yeah, that shows management trying to enhance market perception, make the stock more accessible, maybe more palatable for institutional investors, larger funds.
Tidying things up.
Kind of. So, what we need to watch now, Q3 booking trends. That'll give us a clue on pricing traction. Can they translate volume into higher average selling prices?
Okay.
And of course, keep an eye on ongoing developments in trade policy, those tariffs, any follow-up actions.
Yeah.
That'll be key for the battery materials angle.
That's a clear read on the market's reaction, focusing on operational wins, the strategic vision. But let me play devil's advocate for a sec. If analysts are still calling it high risk, what are the key risks that still loom? How does this strategy mitigate those, or are there still, potential blind spots?
That's a fair challenge. The primary risk, no question, remains the pricing environment for graphite electrodes.
Just the market price itself.
Exactly. While they've shown excellent cost control, if market prices stay stubbornly low for a long time, it's still going to weigh on profitability. Their strategy tries to mitigate this, right? Focus on higher margin U.S. sales, selective price increases.
Right, a push through value?
Yeah. But the global steel market is cyclical. That's an external factor they can't fully control. Another potential blind spot, maybe the pace of adoption in that battery materials segment.
How fast it actually develops.
Right. The tariffs are a huge tailwind, no doubt. But building out a robust domestic supply chain, that takes time. It takes significant capital investment. GrafTech has the expertise, but scaling that side of the business quickly and profitably, that's going to be a challenge.
So they're managing what they can, but macro factors and execution speed are still risks.
Always are. There's always an element of risk there.
All right, it's time for our This Is Not Financial Advice segment, where we bring you an outrageous but plausible trade idea, straight from the kind of pitch you might hear in a high-stakes investment committee meeting.
Okay, let's do it. Forget the short-term noise, forget the EPS miss, forget the commentary about unsustainably low pricing right now. We're looking multi-year. This is a chess game.
Okay, I'm listening. What's the wild idea?
My wild yet plausible trade. A long-term, out-of-the-money call option spread. Let's say for December 2027, centered around the $5 strike price.
Whoa, break that down. Options, out of the money. $5 strike by 2027? The stock was around $1 recently.
Exactly. So a call option gives you the right, not the obligation, to buy the stock at that strike price, $5 by that date, 2027. Out of the money means the strike is way above the current price, so it's cheap, but offers huge leverage if the stock makes a big move up. The spud part just helps manage the cost and risk.
So a leveraged bet on GrafTech hitting $5 or more by late 2027. What's the thesis? Why $5?
The thesis is the market is massively underestimating the combined impact of two things. One, accelerating EAF steelmaking adoption. We talked about that. Every new EAF mill needs their core product. That global shift isn't a maybe. It's driven by decarbonization, incentives. It's happening.
Okay, tailwind one.
Tailwind two, GrafTech's latent potential in battery anode materials. Layer on that game-changing 160% combined tariff on Chinese imports into the U.S. This is effectively the government saying, build it here.
Creating a protected market almost.
And GrafTech, with its needle coke expertise, its synthetic graphite know-how, they're perfectly positioned to be a valuable strategic partner, as they put it. The U.S. government needs cornerstones for this domestic supply chain, and GrafTech has the vertical integration, the tech.
So the current share price, around $1, doesn't reflect either of these.
Not nearly enough in this view. It doesn't reflect the significant embedded option value from these two massive macro tailwinds. The reverse split, that just cleans up the share structure, makes it more palatable for institutional money, reduces the perceived sort of penny stock risk.
So the bet is on a future where GrafTech isn't just electrodes.
Exactly, but potentially a critical enabler in the domestic EV battery supply chain. This call spread gives you leveraged exposure to that eventual re-rating, capitalizing on a return to, let's say, normalized sustainable profitability, driven by both core market expansion and a brand new high-growth vertical.
The risk is managed by the spread.
But the upside, if these green shoots really bloom, explosive potential. This isn't just an EAF bet anymore. It's a green energy arc bet.
Okay, so to conclude our exploration of GrafTech's Q2, we've really seen a company demonstrating strong operational execution real cost discipline, successfully shifting its sales mix towards more profitable areas, and strategically positioning itself for some pretty significant long-term tailwinds.
Yeah, the market, in its immediate reaction, certainly seemed to agree, rewarded that clear focus on what they can control, even amidst a challenging landscape. And while the immediate pricing environment for their core products, electrodes, remains challenging, no doubt, GrafTech's strategic moves in EAF steelmaking and that emerging battery materials market, especially bolstered by recent government actions, it paints a picture of a company with substantial embedded potential.
So the question for you, our listener, is really, how much of this future potential, where you've got industrial necessity meeting the green energy transition, meeting geopolitical strategy, how much of that is truly reflected in the current valuation?
Or is there still significant upside that maybe the market is overlooking right now?
Absolutely something to think about. And remember, this deep dive is strictly for informational purposes only. It does not constitute financial advice.
Please, do your own thorough due diligence and research.
Thank you for joining us on this deep dive. We look forward to connecting with you again soon.